Imagine this. Your tax dollars are building $1 billion NFL stadium, but the returns for the public rarely show up. Take the Buffalo Bills deal, $850 million in taxpayer funds, covering over 60% of the $1.4 billion price tag. On paper, it's billed as an investment in jobs, tourism, and civic pride. In reality, many economists argue the benefits fall far short of the costs. Today, we're pulling back the curtain on how owners use relocation threats and scarcity to secure these deals. And nowhere is that clearer than in Buffalo's stadium negotiations. So how does a football team persuade taxpayers to put up $850 million for a new stadium, more than 60% of a $1.4 billion project? That's the central question behind what many call the Buffalo Blueprint. On its face, it sounds like an impossible request. Families were already struggling with higher living costs, local governments were stretched thin, funding schools and infrastructure, and yet nearly $1 billion in public resources went toward a venue hosting just 8 NFL home games a year, plus a handful of other events. The offer wasn't framed as a giveaway, it was framed as survival. Ownership signaled that without a new stadium, the team's long-term future in Western New York was in doubt. That urgency had real leverage attached. The team's lease was set to expire in 2023, and leaders made clear it wouldn't be renewed without a deal. The message spoke directly to fans' fears. In Buffalo, the Bills symbolized community resilience, not just sport. By tying a new stadium's construction to the franchise's continued existence in town, ownership raised the stakes far beyond football. From the state's perspective, negotiations resembled a high-stakes standoff. Officials faced the possibility of being blamed for losing the team if they pushed back too forcefully. Owners, meanwhile, held the leverage that mattered most: loyal fans and the genuine possibility of relocation. In that context, economic debate took a backseat to political risk. Would the state risk alienating voters by letting the Bills leave? Ultimately, state leaders approved the subsidy amid relocation threats and mounting political pressure. At the time it was approved, it was the largest taxpayer handout for a new stadium in U.S. history. Officials justified their decision by promising ripple effects, construction jobs, tourist spending, and intangible boosts to civic pride. But polls showed most New Yorkers opposed the subsidy, questioning whether these returns would actually materialize. Independent research has delivered a consistent verdict: promised economic booms from new stadiums rarely arrive. Large outdoor venues like NFL stadiums host relatively few events beyond the football season, and most fan spending replaces rather than adds to local entertainment dollars. That means economic growth tends to be minimal, while public debt obligations remain substantial. Meanwhile, team owners often realize immediate, measurable gains. New stadium deals tend to raise franchise valuations, and that value accrues to private ownership, not taxpayers. The Bills' value, for example, had already climbed by around $900 million since their purchase years earlier, and securing a new, heavily subsidized home is expected to push that even higher. Those financial rewards flow directly into the portfolio of the franchise's owners, not into community resources. Buffalo illustrates the mechanics of how subsidies get secured, but the choices aren't always the same everywhere. Some cities have pushed back against these demands entirely, deciding that keeping a team is not worth the price. That path leads to very different outcomes. When a city refuses to subsidize a new stadium, the fallout can be dramatic. Franchises have spent decades pressing for public money, but not every community has agreed to the terms. Two of the clearest cases come from the West Coast, Oakland and San Diego. Both faced relocation threats, both rejected major subsidies, and both watched their teams walk away. Yet the financial and cultural results looked very different in each city. Start with Oakland. The Raiders had already left once before, and the memory of that loss stayed with fans. By the time ownership pushed for another expensive stadium upgrade, city leaders faced a wall of financial realities. Taxpayers were still tied up in costs from earlier arrangements, and there was little appetite to repeat the cycle. When Oakland declined to commit more, the Raiders bolted for Las Vegas, where they secured roughly $750 million in public funding to build a gleaming new stadium on the Strip. San Diego's story hinged on direct democracy. In 2016, the Chargers sought approval for a ballot measure that would have raised hotel taxes to fund a downtown stadium. The team promised economic transformation, but voters rejected it outright. With no deal on the table, the Chargers moved to Los Angeles. The choice fractured a devoted fan base, yet the city avoided decades of new debt service tied to a privately controlled venue. In other words, taxpayers kept budget flexibility even if it meant losing their team. For both Oakland and San Diego, the immediate cost was cultural. Fans lost more than just football games. They lost rituals, identity, and traditions woven into Sundays for generations. Stadiums serve as gathering places as much as sports arenas, and when a team leaves, it takes part of the city's social fabric too. But over the long term, the trade-off shifted. By declining to pour public money into massive new facilities, both cities spared themselves from absorbing obligations that might have stretched for decades. Las Vegas may showcase a glittering stadium now, but residents carry a huge public tab to keep it there. In contrast, San Diego avoided taking on new stadium debt tied to that 2016 proposal, even if the Chargers' departure left an emotional void. The lesson isn't that saying no is easy, it's that it comes with sharp consequences on both sides. Communities that resist stadium subsidies often protect their financial health, but they risk losing teams that help define local culture. Owners know this and they use it. Each time negotiations begin, they calculate how far civic pride and fan loyalty can be pushed before leaders give in. And that calculation is the heart of a much larger strategy that has guided stadium battles across the NFL. How do NFL teams convert community passion into leverage for billion-dollar deals? The answer lies in what many call the relocation playbook. Relocation isn't only about physically moving, it's about creating just enough fear to make public officials and fans feel like they're running out of time. When whispers of departure begin, the threat cuts deeper than economics. It touches identity, tradition, and civic pride. To fans, losing a team doesn't just mean losing games. It means losing the shared Sundays, the tailgates, the rituals that hold a community together. Suddenly, a taxpayer subsidy feels like the cost of keeping something that can't be measured in dollars. The structure of the league fuels this dynamic. Professional football limits the number of franchises well below the number of cities that would eagerly welcome one. That artificial scarcity creates constant competition among markets and sets the stage for bidding wars anytime an owner hints at moving. The Rams' exit from St. Louis demonstrated how powerful this scarcity can be. For years, Los Angeles was the largest market without an NFL team, and when that opening lingered, the Rams' ownership leveraged it as a chance to shift into a bigger stage. The move didn't require subsidy, the stadium was privately financed, yet it still showed every other owner that the threat of relocation can secure influence and headline attention. Oakland's story underscored the same lesson. Raiders fans remained fiercely loyal, but loyalty didn't close the financial gap when ownership demanded upgrades. With no deal on the table, Las Vegas offered hundreds of millions in subsidies, and the Raiders made the switch. What Oakland declined to pay, Nevada delivered. For ownership groups across the league, the signal was unmistakable. If one city says no, another will pay dearly for the opportunity. Buffalo's owners knew how to apply the same pressure. Even without a serious relocation plan, floating the possibility of moving to a richer market like Austin was enough to make state officials nervous. The thought of losing the Bills, an institution woven into Western New York's identity, was politically toxic. It turned what might have been a pure financial calculation into an emotional struggle that leaders couldn't afford to lose. That's the genius of the relocation playbook. Most of the time, you don't need to move. You just need people to believe you might. This constant brinkmanship creates what economists call a collective action trap. Because no city wants to take the blame for losing its team, each one ends up offering richer subsidies to keep pace. Taxpayers fund stadiums whose primary benefits flow to private ownership, and those benefits are substantial. New stadium deals typically boost franchise valuations significantly. In Buffalo, for instance, the team's market value has already climbed by hundreds of millions since its purchase, and analysts expect the new stadium to push it even higher. Owners also capture private revenues like luxury suites, personal seat licenses, and in-stadium rights that don't require public approval at all. The scoreboard for these negotiations is clear. Cities trade scarce public resources for promises of pride, while owners walk away with appreciating assets. Which leaves us with a much bigger question. What are these stadium battles really about? NFL stadiums are never just about sports. They're contests over money, identity, and leverage, with taxpayers often carrying the cost. Teams frame the conversation around jobs and tourism, but the real bargaining chip is the threat of leaving. Economists across decades of research consistently find that subsidies rarely create meaningful net growth and usually shift local spending rather than generate it. So when you see headlines about a shiny new stadium, it's really about public funds securing private gains. For more behind-the-deal breakdowns, subscribe and comment which stadium deal you'd like us to dissect next.